You've probably seen the headlines. Daughter faces a $660,000 tax bill after both parents die in the same year. These posts go viral. People scream about legalized theft, and the outrage goes wild. But here's the problem. The headlines aren't telling the whole story. They leave out details that are really crucial to the story, which proves yet again that the headlines are a bit misleading. They're designed to create outrage, not understanding. In this video, we're going to break down the Ashley Galea case and how the Income Tax Act works and steps families can take proactively to not be so blindsided by a CRA when it comes knocking on the door on your terminal tax return. And here's the reality. CRA will be coming knocking on your door of your estate, especially one that doesn't have the proper planning in place, and you'll end up paying the government tons more money than what should be going to your kids. And it's not about giving the kids or leaving them too much money that they don't know what to do with. It's about deciding to pay them the hard-earned money that you've created over your lifetime instead of the government. So here's what the media told us. The story reported goes like this. Parents die leaving $715,000 in their registered plans. Now, because there's no qualified spouse, because now this is the second parent that's passed away, that's now deemed as income in their terminal tax return. And that tax rate would probably kick off somewhere in the high 40%. Let's just assume that's 48%. That's a $340,000 tax bill. But the asset that wasn't in the headline, you had to dig deeper into the news to see what was going on here, is there was a family cottage involved. The family cottage triggered another $320,000 of capital gains. That leaves the total tax bill at $660,000. And as the story would point out, that leaves the family only with $55,000. Cue the outrage. Cue the death tax rants. Cue the social media fear-mongering. But what is missing is the value of the cottage. So if the assumed tax bill on the family cottage was $320,000, that means that the cottage is worth at least $1.2 million. It's also unknown whether the parents used the principal residence exemption throughout the duration of the time that they owned the property, because that is an option under the income tax rules. And yes, the kids did inherit the cottage. Taxes paid by the RRSP. They didn't lose it, they just used the other assets to pay the tax bill. And therefore the family avoided selling the property. So the actual inheritance wasn't $55,000 of what was remaining of the RSP after paying for that tax bill. There was $55,000 remaining plus a $1.2 million cottage. But let's be honest, kids being left with a $1 million cottage and some money left over from the RSPs doesn't cue the outrage that the headlines did in this particular story. This is also, to be clear, not suggesting that the tax rate on the RSPs and the total estate wasn't outrageous, because I think it is. But I think my main beef with the media is that they're trying to paint fear. They're trying to paint a story here where there really isn't one. And that's because providing context doesn't sell advertising. Fear does. It's like passing an accident really slow to view the carnage. People are just simply drawn to negative things. So I say shame on the media for not providing context, but also there's been a lot of commentary circling around social media on this. And I would say equal shame for financial advisors who are also not providing context and real solutions to this. So let's ground this whole story in the Income Tax Act. There's a couple of rules that we need to pay attention to if we're going to suggest that there's planning options that you could do to avoid this kind of tax bill. The first one we're going to look at is the deemed disposition rule. In Canada, we don't have an estate tax like they do in the USA. But we have this deemed disposition rule that can make the effective taxes just as punitive and just as damaging. And remember, all those assets, capital or real property, are all sold at the fair market value, today's value. And it will be taxable compared to what you purchased that for. And there's other things involved in that, of course, but that's why the cottage was taxable. The The second part that we're going to look at is the RSP rules and the dispositional rules under 146.8.8. And this rule states that the fair market value of your registered plans, your RSP or RIF, are deemed to be disposed of and are fully taxable unless you have a qualified dependent or spouse to roll them over to. And that's why the full $715,000 of RSPs were taxable in the Galea situation. Now, RIFs, of course, fall under a slightly different section of the Act, but the rules still apply on the taxable nature of the disposition. For TFSAs, there's still yet another rule. Those are tax-free up until your death, but anything after your death starts to accrue a taxable gain. And life insurance is covered under the Income Tax Act under Section 148, where life insurance payouts are tax-free to the beneficiaries. There are some caveats to that is beyond the scope of this video, but for most situations, these rules apply directly. So no, technically, Canada does not have an estate or inheritance tax, but we do have these rules that affect capital and real property on the deemed disposition rules, which can feel just as punitive. So even though the headline in the Galea case still is a bit misleading, the pain that people feel is still real. Think about this. The government is encouraging you to save in an RSP over your working lifetime, and so you're diligent, you're responsible, you're disciplined, and you put away in a tax-deferred plan your savings, hopefully for your retirement. But if you die before you're able to extract the full value of that RSP, or God willing, not in a spot where you haven't even touched your RSP, and if you die without a spouse, Ottawa is going to come and take almost 50% of that, if not 50%. Now, why is that tax rate so high? Because we live in a system of progressive income tax. So the more money you make, the higher the tax that you pay on those dollars. And if you collect all the taxable property on your death, your estate could face up to 200, 300, or even more income, which is going to be taxed at the highest marginal rate in your province. And if you allow this to happen without a proper financial plan, that's entrapment. It punishes that discipline. It punishes that responsibility, and it punishes the families that are left behind paying the tax bill. Similarly, this is the CPP conundrum. Imagine paying into a public pension scheme for your entire life, and if you die before being able to take a benefit from that public pension, and yes, there is a survivor's benefit, but it's marginal at best. The funds you've accumulated and you and your employer have paid for doesn't really transfer over to your beneficiaries at all. So here's the real lesson. Don't just outrage at CRA. Start having a proper estate planning conversation between you and your spouse or you and your family. The first thing you consider is proper beneficiary designations on your registered plans. Make sure that you have a qualified spouse listed as either the beneficiary or successor owner to those registered plans. You can also have a financially dependent child as a beneficiary of those plans. That will allow for a rollover where it's applicable. The second strategy would be, in my view, maximize your tax-free savings account. The TFSA is one of the few remaining tax-free or tax-exempt vehicles in Canada. And it's my view that you should build as much wealth here as possible. For the very rare person that this may be applicable to, consider a trust. Inter vivos trusts, which are living trusts or planned giving to either charities or people that are going to be benefiting from your estate plan, can do the giving while you're alive. Now be careful, because if you're doing it through an inter vivos trust, trusts are very punitively taxed in Canada, and attribution rules may also apply. And for more information on those attribution rules, I would highly direct you to your tax professional and the Income Tax Act under subsection 74.1 right through to 74.5. Another possible consideration is the use of a permanent life insurance policy. And quite honestly, this is a big secret that keeps getting missed by a lot of financial advisors in Canada. In the Galea case with the $715,000 RSP and the $1.2 million cottage, they could have implemented a $660,000 permanent life insurance policy, which could have either been a universal life insurance or whole life insurance contract. Yes, of course, there's a cost of insurance. There are insurance premiums to pay, but that would pale in comparison to writing a check for CRA for $660,000. Taxes paid, they could have kept the cottage and the RRSPs. Now, that's not a sales gimmick to try and get you to buy life insurance. That's just math. It's not that the taxes magically disappear because you have a life insurance policy. The life insurance policy acts as a funding mechanism for the tax due on the terminal tax return. Now, to CTV's credit, the article that they had published about this did bring in a tax expert who talked about the value of life insurance and financial and estate planning advice. But here's the reality. Families shouldn't have to buy life insurance to pay for a grandiose tax bill on their parents' passing. In my opinion, Ottawa should probably reform the entire Income Tax Act altogether. I mean, after all, it was supposed to be temporary in 1917. But when a government-created solution to a government-created problem means that your entire value of that solution is taxable, one can't help but wonder if it was an agenda just to create more taxes to begin with. But here's 3 policy ideas that Ottawa can do to change income tax policy in this regard. Number 1, allow partial RSP rollovers to adult children. Number 2, cap the effective tax rate on a terminal return. And number 3, raise tax exemptions for middle-class families. But the state killed that conversation, just like they killed the capital gains inclusion rate fiasco last year from the budget in 2024. Had the government kept their promise on increasing that capital gains inclusion rate, so many families would have been crushed under the weight of the tax that they didn't even know hit them. So let's be honest, at the end of the day, the Galea family didn't lose everything. They inherited a nice cottage, a nice family cottage, and I think that's a fantastic thing for the family. And they did have $55,000 left over from the RSP after considering paying all the taxes. But the way the story was crafted, and quite frankly, the way that policy was done by Ottawa, creates a lot of fear and resentment about the system. And they're right. But the solution shouldn't be fear and panic. The solution should be proper planning. Use your TFSAs. Use the ability to have beneficiary designations on your registered plans. And yeah, even consider using a permanent life insurance solution to solve the problem of tax. And as Canadians, we need to demand changes to a tax system that doesn't prey on families at their most vulnerable time. Because let's be honest, CRA shouldn't be getting the lion's share of your money. They shouldn't become your largest inheritor on your death and the biggest silent partner in your business. If you found this video to be helpful on your journey of learning history, economics, politics, financial literacy, and philosophy, make sure you like, subscribe, and hit that notification bell to make sure you're informed of upcoming videos.